There are 3 points I think that I'd make at this point in time. And the first is that we're still in a period of heightened uncertainty, and I think that will persist for quite some time yet. But my second point is that we are starting to rebound now. Some countries are opening themselves back up, including ourselves. We're starting to see more businesses go back to work. And I think the economic numbers that we're likely to see over the next year or so will be better than we originally thought just a few months back. And that is mainly due to the huge success that we've had as a nation in containing the virus. The last point that I'd like to make is both the RBNZ and the government have really opened up the checkbook, so to speak, and they really are doing everything they can to lower interest rates, make financial markets stable, but also pump stimulus into the economy, not just to get us through this lockdown, but we're also we've seen a budget which is starting to look to the future and starting to find ways in which we can stimulate growth out of this situation. What is the world going to look like as we come out of this? And it's a very good question. I mean, the simple answer is that most of our economy will go back to how it was eventually, but there are some parts of our economy that will be hit particularly hard and maybe face some significant structural changes. Now, we've all seen this, the bubbles going around the world. The virus is still spreading, but we have done an exceptional job of crushing our curve, so to speak. And there's no doubt that the move into level 4 and into level 3 was successful. The chart on the right there that shows the orange line declining is what has happened, and with very simple analysis as to what happened overseas, we would probably have around 100,000, possibly as many as 1 million cases today had we not gone into lockdown. So that's been a fantastic achievement. But when you look at our little bubble compared to all the bubbles around the world, what it does mean is that we're going to be that much more nervous to allow tourists and foreigners into our country because we don't have that herd immunity which some other countries are getting. So there is going to be a significant part of our economy, obviously tourism, hospitality, that will be affected by our actions over the next year. Good news is it looks like we're going to get out of level 2 at some stage and into level 1 much earlier than we were anticipating. But I think level 1 will be something that'll be with us well into 2021. What's happening globally? Well, given the nature of this shock, the level of uncertainty, so to speak, as measured in this index, is at all-time highs. We've never seen this sort of jump in global uncertainty, and that includes some pretty big events on there, like the global financial crisis, 9/11, Brexit. We've eclipsed all of those major events. And what we see underneath that in the blue bars is the uncertainty around global trade. And that was climbing well ahead of the coronavirus pandemic. And it was actually brought about by the trade war between the US and China, which is intensifying today, and I think will persist probably for the rest of our careers, to be honest. So that's festering in the background. And it does mean that there's a lot of caution out there among companies trying to find out what new normal is, trying to rejig their supply lines, and exactly how we work our way through this is leading to a lot of uncertainty, and that will be a handbrake on growth for, I think, a little while. But then when we look at what we're actually producing globally, so industrial production, which is a very good indicator for asset prices, you can see that we are contracting at the moment, and I think we fall further as global supply chains are still disrupted, but we will bounce back very strongly into next year, and we're already seeing Chinese manufacturers opening up, New Zealand manufacturers opening up. We're starting to open ourselves up slowly, and that can only point to a decent rebound into next year. So I think asset markets, including equities, We'll be a little nervous for a little while longer, but the fall in equities that we've seen so far is actually quite small compared to other periods in history. Now, this is what we have done through this episode, and I think it's good to note that both the RBNZ and the government have done a pretty good job. So we started off with the central bank cutting from 1% to 0.25, and up until last week they are still saying we're going to stay at 0.25%, but there is a risk down the track that we may have to see a negative OCR, negative cash rate. They also came out and they supported financial markets with swap lines for US dollars and term asset facilities for banks, just to make sure there's loads of liquidity out there, and there is loads of liquidity, but that's what dried up during the 2008 crisis, so they made sure that that wouldn't happen again. The big thing that our central bank has done is quantitative easing for the first time, large-scale asset purchases. They started out saying they would do 30 billion of government bonds only. They then extended that to 33 to include LGFA, and they, as of last week, extended it again to 60 billion. Now, there's a bit of confusion in markets at the moment around, is that a hard number? Can they go further? Of course they can go further. As the government issues more debt, they can keep increasing their large-scale asset purchases for as long as they need. On the other side, I think what the government has done, the best thing so far has been the wage subsidies, coming out and providing wage subsidies. And the reason we got wage subsidies is because they've used them before, they've worked before, and they are working again. And we've now seen in the latest budget as of last week a huge increase in the package to deal with the coronavirus and stimulate a recovery. So you have about $60 billion worth of measures to get us through this period, but also to stimulate growth over the next 5-10 years. And I think the size, the scale of what they are doing is great, and it really does do justice to what we are seeing. And there's a beautiful symmetry here between what the central bank is doing and what the government is doing. You see, central banks increased their large-scale asset purchases to 60 billion, and it just so happens that the government has increased their package to 60 billion. So there's a bit of an offset there. But as the government receives less revenue and continues to spend more, there will be greater deficits down the track. And I think that total number from the RBNZ can continue to increase as need be. But what we saw in the budget, I think, was quite clever. They continued the wage subsidies, which were working, but it's for companies who have seen a fall of 50%. They've obviously increased infrastructure spending. I like the fact that they're tackling public housing, another 8,000 homes there. That's what they're good at. More money on training. I think that's critical to try and move labour from one area which may be hemorrhaging jobs and into an area where we actually need more labour, like tourism, and if we can put that into construction. More money on health and environment. I think the key here to note is this is all wrapped up in a COVID-19 package, but most of it we should have been doing anyway. We have underinvested in investment in infrastructure for 30 years. We've underinvested in health and education, and we could do more on climate change and well-being itself. So it's good that we are seeing money being deployed into these areas, and I really do believe it will lead to a more productive, healthy economy going forward. Now, just to give you a sense of the size, the fiscal impulse that we talk about, so how much extra spending the government's going to do and what that's going to contribute towards growth, is a massive 6.5% of GDP. So it's a huge amount of stimulus coming through in the next year, and then it's still increasing off a very high base throughout 2021 fiscal year, and then it starts to contract because you can't keep growing at those sorts of rates. But what that does do is it really supports the recovery into 2021, 22, and try and get us back to something close to the old normal, something close to the old trend that we were on. And this is the government or Treasury's forecast here. And I think they're a little optimistic, but you can't really criticize too much, to be fair, given how much is being thrown at this. So what we'll see is quite a sharp contraction in GDP. We all know that. We're likely to see a 20 to 25% contraction in GDP in just this quarter that we're in now. But the path back does look a little optimistic, but we should be back towards our old trend by around 2023, 24. And that would be a pretty good outcome given the size of the shock. But unfortunately, we will lose jobs. We are losing jobs now. And most of us are around the same sort of level when we're forecasting the unemployment rate. We're all looking for a rise to around 9–10%. Now, Treasury gave the government these forecasts about a month in advance of the budget, and they said, if you do nothing, you will get an unemployment rate that goes into the high teens. If you spend an extra 20 billion, you'll get an unemployment rate that looks like this. If you spend an extra 40, so 60 in total, you will get an unemployment rate that's probably not going to break through 10%. And they took that advice, clearly, and that's why we've got a package as large as it is. And the impact on inflation is pretty clear. The one part of this which I think is key to long-term growth and productivity is the amount of money that is being put into sort of shovel-ready, as they say, infrastructure investment. And we look at that, and I've actually been arguing for this for years. We should have been doing this over the last 30 years rather than trying to fast forward it all in one go now. But as they say, you never waste a good crisis, and here we are with the excuse that I think we've needed for years to start investing in good infrastructure projects that we've neglected for decades. What's that going to do to our fiscal position? Well, it's going to weaken it, no doubt. But relative to most countries in the world, and I do mean most, we will still be in a relatively strong position. Our net debt to GDP will go from around 20% to about 53, 54%. Most governments in the world would love to start at 50%. Most of the governments in the world are starting well above that. And of course, they are responding and they are pushing their debt to GDP higher. So we're starting from an incredibly strong position, and relative to our peers, we will still be in a relatively strong position in 5–10 years time, and hopefully we'll be in a position to start unwinding that back. But I hope we don't go all the way back down to 20%. I think that was too low to start with, and obviously that comes about by a government running deficits for a number of years, so collecting less and spending more over the next 5 years and funding it through the NZDMO. And there's plenty of demand out there for our bonds, particularly given the RBNZ is a huge backstop buyer and prepared to take down 40 to 50% of that market. Now, looking at the RBNZ, the monetary policy response, as I said, they cut to 25 basis points, but they've also signaled that at some stage they could go into negative. Other economists have said that's quite likely. I disagree. I don't think negative rates are what we need, and I don't think negative rates will achieve what we want. But it's not about what I want, it's about what may happen, and I do think there's a high probability of 30–40% that we will end up with a negative OCR in a year's time if we don't rebound the way that we think we might. Now, the market's already starting to price that in. As you see the dark green line at the bottom there, as far as the financial markets are pricing, there is a minus 10 basis point cash rate in the market right now. And what that means is they've basically priced in a 70% chance of a 50 basis point cut from plus 25 to minus 25. Or they are pricing in roughly a 50% chance of a cut from plus 25 to minus 50, which is where most of us think the RBNZ would probably go if they choose to go negative. And the whole idea of going negative like that is to smash retail deposit rates. So thinking of the tools that I think the Reserve Bank should use in order of what I think, how I think that they would work best, is we have a large-scale asset purchase program, which is currently at 60 billion. It's done a very good job of lowering government bond rates and flattening the curve and providing stability in financial markets. So going forward, if we see any dislocation in the financial markets, or if we see, the government needing to issue more and more, the RBNZ can simply increase their large-scale asset purchases and continue to take down debt. So at the moment, they're at 60 billion. The government is going to increase the nominal amount of debt from 75 billion to 213. So if they're to take down 40% of that, there's 85, and you can add on LGFA, Auckland Council, and a few others, and you could get up to 90 pretty quickly. But if they wanted to take down 50%, which they could, then you're around 115, maybe as much as 120 billion. So they could actually double the LSAPs again, this time next year if they need to. So there's plenty of ammunition left in quantitative easing. The second tool, if you like, which is working well overseas, is term lending for the banks. So provide term lending to the banks, and that reduces our reliance on wholesale funding elsewhere, which does seize up at times, and it may encourage us to reduce retail deposit rates. And I think that would have a more direct impact on lowering retail deposit rates and therefore retail lending and business lending rates. I think that would be more powerful than a negative interest rate. The other thing they can do is FX intervention. Our currency is trading probably a little high where we would like to see it. The Reserve Bank has the currency declining in their forecast, which is quite helpful because that stimulates our export sector. It also puts a bit of upward pressure on inflation, which we need right now. I think FX intervention can be useful if done well, but it's very difficult to come out and say the currency is at 61 cents, we wanted it at 55. We're simply too small an economy. Our currency is one of the top 10 traded currencies in the world, and we're not in the top 10 economies. We're not in the G20. So it would be very difficult for us to do, but it is a tool that could be used. And negative rates at the bottom, I'll reiterate my point around I don't think they will work. What we've seen overseas is they actually force a higher level of savings, particularly as retirees have a nest egg and they're trying to earn an interest income off that, and that turns negative. As they go into retirement or while they're in retirement, they spend less and have to try and save more where they can. And it certainly doesn't help people who are trying to build a deposit for a house or trying to save for other things. And what we've seen overseas is when you go into negative rates, it actually puts downward pressure on expectations of inflation and growth from that point on. But long term, it can be seen as an intergenerational wealth transfer. So taking it from the older generation and giving to the younger generation. And if you look at the demographic impact that we've seen on interest rates over the last 40 years, 75% of the decline in interest rates globally can be explained by demographic forces. Quite simply, we've got a whole lot of people aging with a lot of wealth and a lot of savings. So the savings curve has increased, the demand curve has decreased, the price of credit interest rates have declined. And I asked Massey University to model this for me, and based on our demographics alone, we see negative interest rates becoming a common thing in the 2030s and 2040s. So maybe it is inevitable. I've got some pretty cool charts on our data that we have internally here at the Mighty Kiwi Bank, and it gives you some insights as to what we've seen through the lockdowns. Most of it's pretty obvious, but it's cool to see on charts. The first chart there is the grocery stores, and we saw the great toilet paper rush of 2020 as we all stockpiled into lockdown. But then the spending in grocery stores throughout lockdown increased, obviously, as we didn't have other things to spend our money on. And what we saw is, grocery stores represents the majority of our spending on any given week. But it moved from a proportion of around 20% to getting close to 30-40% of our total spending. So there was a huge spike in grocery store spending, as you'd imagine. But we also saw delivery food bags picking up, and the two charts that I like at the bottom there, increase in spending on meat and alcohol in the lead up to the lockdown, and that sends some flashbacks to university days. So as far as I'm concerned, that's perfectly reasonable behaviour. And what we saw elsewhere, obviously fast food dropped to near zero, and then as soon as McDonald's opened back up, we were straight back out there. But spending doesn't look like it's actually back to normal levels yet in the fast food area. Our spending on fruit and veggies is actually a lot higher. So maybe we are eating healthier post-lockdown. Hopefully that continues. But the areas where you would expect most of an impact is cafes, restaurants, and bars. And even though we've seen a decent lift in the level 2, it's still well below where the pre-lockdown levels were, and that's something which obviously level 1 will help to address. And it would be interesting to see how long it takes us to go back to spending a normal amount of money in these areas of the economy. So one thing we've noticed, being in level 2, is we're just not spending as much as we were prior, and given the social distancing and the restrictions, we're still not spending anywhere near as much in bars, cafes, and even fast food by the look of it. So some interesting points there that we'll keep looking at to see how that plays out as we go into level 1 and towards something closer to normal. But there are clearly some businesses out there, cafes, restaurants, anyone in the tourism sector, that are continuing to do it very tough. And this is where we're expecting to see most of the damage from the lockdowns. Overall, our spending is still down. So how much money we're spending on credit cards obviously dropped quite substantially into lockdown. We went from spending in stores to spending online, but we just weren't spending anywhere near the same amount. We've started to see a gradual pickup in the amount of credit card usage, but in the last couple of days, as you can see there, it really has dropped off a cliff. And I think that's just as kids went back to schools and parents went back to work and probably didn't spend as much over the last couple of days as usual. But we expect to see that continue to pick back up to its longer term normals. It's just taking time. So given everything that we know, yeah, we're going to have a massive contraction in the second quarter, but geez, we're going to have a massive bounce back into 2021. a lot of that increase in our expected GDP growth is on the back of fiscal stimulus, but also the fact that interest rates are really low and the RBNZ's doing its part to make sure that financial conditions are relatively loose. And adding to that, that they have loosened LVRs as well, which will hopefully play a part in the housing market. So where the rubber hits the road, it's around the unemployment rate. A rise in the unemployment rate from roughly full employment, where we were around 4%, 4.25%, to 6% is, it's okay. But a move from 6 to 8%, the economic models start to show, default rates lifting, the economic impact really starting to bite, and then a move from 8 to 10% and 10 to 12, 16, and so on. It's a bit of an exponential reaction to default rates, what the influence on housing market and other parts of the economy. So the fact that we're hopefully going to stop around that 10% level is good, and we'll hopefully see that come off quite quickly over the next few years. But there is some damage in there that we can't ignore, and that is the potential impact on the housing market. Normally, when you see an event that induces that amount of unemployment, that flows through to people's confidence in buying assets in general. Obviously, when your job security is not there or evaporating, you're less likely to go out and spend on big ticket items, housing being one of them, or your ability to leverage into the housing market is cut off. So at I guess a conservative estimate, we are forecasting the housing market to see a decline of around 8-9% in the near term, but then to bounce back next year and into 2022. So just saying that, there are three, I would argue, very strong supporters of the housing market still there. One is interest rates are pretty low. The RBNZ has removed the LVR restrictions for 12 months. So you'll see, some banks coming out there now saying you can leverage up to 80% on an investment property. You can leverage a bit more on your first home. So that helps get some people across the line, both a lower interest rate and a little bit more leverage. That'll support the market. The other part, which we've documented for a few years now, is the chronic shortage in housing across the nation. So there is at least 100,000 shortage of affordable dwellings around New Zealand. Most of that's in Auckland. A shortage of dwellings means that the price adjustment should be less, because there's a shortage of good supply out there. If there was an oversupply, like we saw in Australia a couple of years ago, then prices can fall much easier. The last one is a little complicated. It's our population growth. We've had fantastic population growth, and right up into the lockdown, you see that chart on the bottom there, there was a surge in Kiwis coming home. I had a couple of mates coming home from overseas. And we've had fewer Kiwis leaving, obviously. So we've seen our population go through 5 million pretty quickly. All of that is supportive of the housing market. More people, you need more homes. But where that goes from now is going to be particularly difficult to guess. So assume we open ourselves back up. I imagine there's a bunch of Kiwis there. My two mates, as examples, will go back overseas. And I think, we may see fewer Kiwis coming back. But then I think when we turn the tap back on to migrants, I think New Zealand Inc., I think our brand is so much stronger now, on the back of our actions and the back of our ability to do what we've done. So I do think migrants will return, but population growth, I think, over the next few years will be definitely lower than what we've experienced over the last 5 or 6 years, which has been one of the biggest migration booms in our country's history. what all this means for inflation, and then bringing that back to the central bank and the government. Well, we're in a recession, so recessions kill inflation really quickly, and you actually see prices fall in a number of areas. So if we're right and we see house prices starting to come off a little bit, then rents aren't going to increase at any rate that we've seen recently. They'll probably cool as well. And given the weakness in the labour market and weakness in consumption and expectations, I think the risk to our inflation is deflation. And I think we could see a period in the next 6 to 12 months where prices in general are falling across the economy before they start to bounce back into 2022. Given that, and given the unemployment rate's going to 10%-ish, inflation is heading to zero, maybe below, that's your dual mandate as a central bank. So as a central bank, you're going to potentially do more than what you've done today to try and turn both of those around. And they will further support the policy which they think is most appropriate right now, which is fiscal policy. So we could see even more from both the central bank and the government in next year's budget, if needed. Also pushing inflation down is the decline in oil prices that we've seen globally, an increase in supply at precisely the wrong moment as demand dropped quite substantially. And we actually saw a negative price for a barrel of oil of minus $40. So oil goes into just about everything. That's one part that does really show you where global inflation is going. And with global inflation quite weak and our import prices falling, that does really point to some more downside pressure on our local inflation. Now, before I stop, I just want to leave you with this chart, because it scares me. I sort of wake up in the middle of the night thinking about this, and that is, protectionism that we've seen post-crisis. And if you look at the trade restrictions that we're placing on each other sorry, when I say post-crisis, I mean post-GFC 2008. We've seen trade restrictions ratchet up every year, and going into an election, I think Trump will be talking a lot more about fighting China on at least on trade, and we could see this continuing to increase. So I think we're in a world now where over the last 10 years we've seen globalization stop and start to come down. That may continue, and in a post-COVID world, I think most companies at best will try and diversify their trade a little bit. A lot of countries, including ourselves, will look to onshore what we can, and that just may mean we go through a period of 5-10 years where we're of deglobalization, and that will have implications on trading relationships and costs as well. Just thought I'd throw that out there. But thanks for listening.